The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Hello there, good morning. It's Mitch Goldberg. You are listening to Money in the Morning with Mitch Goldberg. Thank you so much for joining us. Happy, healthy Monday to you all. Mitch Goldberg with Client First Strategy. That's clientfirststrategy.com. Futures are down 150 in the Dow Jones. S&P futures down 31. NASDAQ down 132. That's a little over 1%. Oil down $1.63 at 78 West Texas Intermediate, and the 10-year Treasury stands at 3.54%, up a touch. Mortgage rates on a national basis are about 6.2%. Stocks look like they want to just give back a little bit of the gains from last week. So we had a good week last week in the market. A lot of the credit goes to Tesla, which had a 30% plus gain in 1 week. I mean, that would be a great return for a year. They had it in a week. Don't forget, though, the stock had been down about 40% before that. So until the stock gets to about 210, 215, where people started to really think it was a good buy, let's just all relax and calm down. But if you are an owner of Tesla stock, I'm glad you're recovering. I want to give a shout out to American Express. American Express is up over 10% just on Friday. That's a huge gain for a stock like American Express. So it was a good week. Blue chips did well. Tech did well. Basically, every sector did very well last week. So those good weeks are the reason why we say time in the market is more important than timing the market, because if you decided the week before stinks, I'm going to get out and wait for a better market, well, you had a nice big rally, and now you're going to say, well, I'll just wait till it goes back down again. And then it starts to go down again, and you'll say, well, it could even go lower. And then it goes back up a little bit. And you say, no, I could have bought it when it was lower. Then it goes up more. And then you say, oh, I should have bought. It just becomes endless procrastination. I actually think it's just so hard and such a nuisance way to invest. But that's me, because I am an investor. I'm not a trader. I'm not knocking you if you're a trader, and I love to talk about trading. But we're investors here at Money in the Morning with Mitch Goldberg. The spread between the 10-year and the 2-year, we call that the yield curve, is negative 0.69%. So when we talk about the yield curve, it's like this esoteric mumbo jumbo industry jargony thing, and people think, maybe they're sounding sophisticated. Oh, but have you seen the yield curve? And you put their pinky in the air and go, yield curve. Let me just explain something to you. Okay, the yield curve is a real thing. And typically speaking, short-term interest rates are low, and when you go long-term, interest rates go higher. So the longer term you invest in something that pays interest like bonds, the more you expect to get. But sometimes that relationship is flipped, and it means that people think the future outlook of the economy is, they're not confident in it. So that's what the yield curve implies. And typically speaking, the way it works is this: banks get your money. Banks take your money in terms of a checking and savings account, and they pay you very little. And then they take that money and they loan it out for more money. And that's the spread that they make. That's how banks make money. It's called net interest margin. When banks can't do that, they often stop lending, or it slows down certain kinds of loans. And if banks aren't lending, that means credit is drying up, and our economy runs on credit. So if credit dries up a little bit, that means the economy slows down, and that could be recessionary, which is why the yield curve is a very good indicator, reliable indicator of recessions. By the way, you can't invest directly into an index, but you could invest in a security that tracks your membership index. I have to say that. You're going to have to just get used to me saying that, okay? We have a huge week this week for stocks. This is just a crazy monster week. We do this every quarter. Almost half of the companies in the S&P 500 are reporting earnings just this week alone. We also have the Fed meeting. The Federal Reserve meets about every 6 weeks, 8 times a year. So the first Fed meeting of the year starts tomorrow. It's a 2-day meeting, so tomorrow and Wednesday. And Wednesday at about 2 o'clock, we will know what the Federal Reserve has done in terms of interest rates. It is widely expected that the Fed is going to raise interest rates by just 1/4 point. They've been going 3/4 point for 4 meetings. The last meeting, they went 1/2 point. Now we're just talking 1/4 point, meaning 1/4%, or 25 basis points, however you want to look at it. And that is because the Fed is starting to see a little bit of evidence that their rate hikes are working, slowing the economy down to take some of the oomph out of inflation. We'll see if it works, but based on the GDP report for the fourth quarter that came out last week, non-farm payrolls were, first-time, I messed it up. First-time unemployment claims were under $200,000. 200,000 people, excuse me. I'm all over the place. Sorry, it's Monday morning. The big statistics that came out last week don't really tell you that there's a recession on the way or even that the economy is slowing down. And that's kind of confounding a lot of people because all you hear about is talk about an upcoming recession. So we are just getting so much so many cross currents and mixed signals in the big numbers that investors are just trying to figure out what they should do. And that's why I think you're seeing a little bit of give back in the futures today. Now, when we talk about the futures, the Dow futures are down ahead of the market. It doesn't mean it's going to be a down day in the market. It doesn't mean the market's over for the week. It's just a snapshot at this particular moment. And by the time the market opens at 9:30, by the time we get to 9:35 a.m., stocks could already be up. So these are just very short-term indicators that we talk about just to help us get ready for the day, but it doesn't really set the tone for your financial goals in 10 or 20 years. I promise you, you will not remember what the futures did today 10 years from now. I promise you that. If you do, well, maybe you're just one of the few people who are like that. I'm not. Okay, so what's the big week for? First of all, we've got earnings coming from trillions of dollars of market caps, just from individual companies. We have reports coming out from Meta. Do you know who Meta is? Meta is Facebook. They changed their name to Meta to reflect their desire to be a metaverse company, and Facebook is merely a big part of the company. But when they report tomorrow, what we expect to see is how is the advertising business doing? They are a big advertiser. I should say they're a big advertiser platform. So how are they doing? Is Mark Zuckerberg going to come out and say, you know, this metaverse thing we're spending tens of billions of dollars on, we're going to be a little more financially disciplined on it. We're going to take our time. That would be music to investors' ears. The stock, for all intents and purposes, on analysts' estimates, analysts' opinions, seems to be like a pretty cheap stock. So we need to see if it's a cheap stock that's going to remain a cheap stock for good reason, or can the stock rebound based on a rebound in advertising and a rebound, or I should say, with a more financially disciplined company. On Thursday, we've got just a flood of earnings. We have Apple, Google, which is called Alphabet, and Amazon all after the bell. So within like a 15-minute span, you've got these 3 monster companies coming out with earnings. Apple, we're expecting revenues to be down slightly, maybe 1%. That's the street estimate. We just want to see what's going on with iPhone sales because, ever since it came out with the iPhone in 2009, that's all they've ever really been is an iPhone company, but with this incredible platform. We need to see if there's growth continuing, if there's demand for the 14s, and we need to see if the supply issues that they're having are clearing up. Samsung is actually telling us that they now see a glut of chips, and they might even slow down production. So we're really starting to see evidence that the supply chain issues with chips is starting to abate. We also have Amazon, and that's going to tell us about the strength of the consumer, a little bit about advertising. And of course, Google is the company that tells you how the advertising business is, and Google is basically a search engine. With everything they have going on, they're still 90% plus a search engine company. So we have some huge things to see next week. Monday, today, we have Whirlpool I'm going to keep an eye out for Whirlpool's numbers because that'll tell us the strength of the consumer, strength of the housing market. And then we have Caterpillar tomorrow as well. Again, Meta, if I said Tuesday, they're coming out with their earnings on Wednesday. So that's the update in the market. And then we're going to talk about a couple of other things. You want to stay tuned because we're going to talk about what to do with all this information and what you should be doing now in terms of measuring your risk tolerance, how you should buy stocks. And British Petroleum actually came out and said they see lower demand for energy because of renewables growing. So much going on. We're going to talk about all this. You're listening to 103.9 FM, LI News Radio. We'll be right back. Okay, we're back. Hello, and let's just cut the music right now because we don't have, time is brief. All right, you're listening to Money in the Morning with Mitch Goldberg. Check us out, clientfirststrategy.com. Ford just announced a price cut to the Mustang Mach-E, which I think is hot. I mean, I just love the way that vehicle looks. They're doing this because Tesla cut the prices of their EVs. So Ford, which is now the number 2 seller of EVs because of this particular Mustang Mach-E. And it's, price cuts spark demand. And if we see more price cuts from other companies, we see more electric vehicles on the road. I just wonder where all these people are going to charge their cars. Yes, I know we charge them at home. I wonder what it's going to do to everybody's electric bill because the demand for energy goes up. These things do use a lot of energy when they charge. Oh, I could just go on to a whole riff about electric cars, but let's get into some other things. Ford, by the way, is off a little bit this morning on that news, and the futures, the Dow futures are down 155. They're down 133 right now. So these are just moving targets. We don't get too stuck on them, and I just want you to know when you hear futures up or down in the morning to just calm down. I think these are spoken about like they actually mean something to get people to listen and follow, I guess, right? But I just want to give you the real deal. Let's talk about what to do with this information, okay? First thing is you have to identify something called risk tolerance. Now, before you go, he's talking about risk tolerance, this show just got so boring. It's not boring. Risk tolerance is really important. The hardest thing to know, and this is just my philosophical view, the hardest thing to know is to know yourself. And risk tolerance is really hard to know because when I bring on new clients in a rip-roaring bull market, they have a high risk tolerance because they, it's like their head is filled with dopamine, all the money they're going to make. And I have to calm them down and say, no, your risk tolerance isn't that high. And when the market is really, really down, and if I bring a new client in now and they just got crushed in Roku, keep in mind, I'm saying not my client, a new client coming in, they got crushed in, that alternative meat company, right? Beyond Meat, whatever, they have a very low risk tolerance, and sometimes I have to bring them up. So risk tolerance is a moving target, and you really find out with experience. So to say this is your perfect exact risk tolerance based on a risk questionnaire and a conversation, we do our best, but we aim, we fire, we recalibrate, we aim again because it's a moving target. And ultimately, when you become more experienced as an investor, you'll start to realize what kind of investor you are. And some people say, I just want to stick with the blue chips. If I haven't heard of the name in the past, I have no interest in it. And that is one way to go. That's risk tolerance. And when you invest over and above your risk tolerance and you get hit with a bad market, you suffer losses. And it's really tough to stay in the market when you're doing so badly. And when your risk tolerance is not aggressive enough, you risk undershooting your potential needs for retirement. So if you take too little risk now, you just keep all of your money, for example, in a savings account, you're basically really, it's going to be really hard for you to meet your financial goals in the next 20 plus years. But if you invest in junky individual stocks, and you just throw all your money into some weird cryptocurrency like Dogecoin or something that you never even heard of, and these things go down, you've probably suffered a permanent loss and you're never going to make that money back. So risk tolerance is really learning about yourself. And I think as a financial educator and a financial advisor, someone who has the heart of a teacher, any financial advisor, a good one, should really help you discover yourself. It's almost like a psychologist or a therapist to help you discover what your true risk tolerance is. Because once you understand that, you could prioritize the investments that you want to be in, and investing doesn't become an experiment, it becomes a process. And once you have a process, you could trust the process and surrender the outcome. How to buy stocks is another thing I like to talk to people about. And you could use this. I do this a lot for my clients, but you could just take this information and run with it. Let's say I want to buy 100 shares of a stock. And, let's say the stock is 80. Maybe I'll buy 40 shares at 80, and I'll put a below the market buy limit at, let's say, 5% below. So it's 76. Okay. For another 30 shares of that stock, maybe another limit order at 72 for another 30 shares of that stock. And this way, if the stock fluctuates, because the odds of you buying a stock and the stock never ever going down after you buy it are very, very low. Stocks just fluctuate with the market, with interest rates, with the psychological whims of investors, with the weather, with geopolitical news. It's countless the amount of reasons that stocks move. But you could take advantage of the volatility and buy into that, make volatility your friend by using below the market limit orders. Your risk, of course, is if the stock doesn't go down enough, you don't get filled on your entire position. So you maybe only get the 40 shares you buy at the market, the next 30 shares you buy below. Maybe you don't get that last bottom 30 shares. But if things are good with the company, you'll be willing to pay up a little for the stock because you'll have a higher comfort level, a lower degree of risk to buy the stock. Potential lower degree of risk, I should say. So this is why it's important to have a strategy. And when I build portfolios for people, it's not just individual stocks. Some people are just exchange traded funds that follow a general index like the S&P 500. And in that case, you might put together a portfolio of 7 or 8 different types of index funds, from 10-year treasuries to emerging markets, small cap index, a mid cap index, a large cap index. And if you use exchange traded funds, you could actually use below the market buy limit orders as opposed to a mutual fund. They just trade at the 4 o'clock price every day. And if you want to automate it, you really just have to pay attention to the fund when it drops 4%, for example, and buy more shares. The tough thing is people don't do that, and you lose discipline, because if the market goes down, you'll say, well, now the market's going down, so may forget the 4%. I'm just going to wait and see what happens. And then it goes even lower, and you hesitate, you don't buy, and then it goes back up, and you hesitate because you could have bought at lower prices. And again, it becomes endless procrastination, which is like the total opposite of a disciplined strategy. So we need ways to put in discipline, take our emotions out, and below the market buy limit orders is in my experience a really solid way to go. Does this make sense to you guys? I hope it does, and I hope I explain it the right way. And I would love to talk more about this, but I don't want to spend so much time on this. And let's talk about ways to sell a stock. So if a stock starts to go up, you could actually use trailing stop orders. Stock goes from 80 to 120. Maybe you want to sell some at 120. Maybe you want to put some to sell if the stock drops 3%. And if the stock goes from 120 to 150, that 3% limit, which would be, let's say, at about 116 or so, that will follow the stock up, and now it'll become, let's say, close to 142 or 144. So these are the kinds of strategies that we use to put some discipline into a portfolio, which I think is actually sorely lacking. And you're listening to 103.9 LI News Radio, and this is Money in the Morning with Mitch Goldberg. Darn it, the time goes by so freaking fast. In any event, The last big thing this week is the non-farm payroll figures that are coming out on Friday. That's going to be a big tell, the January non-farm payroll figures, to see if the labor market really is weakening, which would give the Federal Reserve more room to pause and more room to even think about pivoting. So when the Fed stops raising rates and leaves them alone, it's a pause. When they start to cut rates, it's the pivot. So the non-farm payroll is coming out on Friday. That is the big number. We get that every month, and that is really always the number of the month because it's always potentially a game changer. Thanks so much for listening. Happy Monday. I hope you guys have a great rest of the week, and I'll be back tomorrow morning. LI News Radio 103.9. Get ready for day.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and opinions expressed